Welcome to the deep dive. Okay, let's set the scene. Picture it. Late 2009. The world is still, reeling from the global financial crisis, companies everywhere struggling, taking bailouts, or worse. But then you stumble across this one shareholder letter, and the tone is completely different.
Yeah, that letter was from Fairfax Financial Holdings Limited. And they weren't just getting by, they were actually celebrating. They wrapped up a decade that financially wiped out so many by calling 2009 one of our best years ever. It's quite something.
It really is a stark contrast. I mean, think about it. From 1999 to 2009, the S&P 500 actually gave you a negative return, minus 1.0% per year. Yet Fairfax, during the worst of it, 2008 and 2009, they managed to grow their shareholders' equity by something like $3.3 billion.
Uh-huh. Which is why we're doing this deep dive today. We want to unpack exactly how they pulled that off. We're digging into that specific 2009 letter to find the blueprint, really. It's this mix of super disciplined insurance business combined with some seriously contrarian, almost aggressive investing.
And that combination led to, what was it, a 61% increase in book value per share, excluding dividends, right through the crisis.
Exactly. Way, way better than the rest of the industry.
So let's start with the scorecard, because the numbers themselves just tell a powerful story. 2009 alone, book value per share jumps 35% to $369.80.
And it wasn't just a lucky year. You look back since they started in '85. They compounded book value per share by 26% a year, annually. That kind of history, that long-term view, it sort of explains why they were willing to take certain kinds of risks later on.
Right. And what gets me is even during that so-called lost decade for the market, 1999 to 2009, they still performed. Okay, they didn't hit their 15% growth target, but they still managed 9% a year compound growth. While the S&P was negative, they were almost like immune.
Well, they see their fundamental business as a cash flow machine. That's the key. They are, at their core, a property and casualty insurer, a P&C company. That's the engine room, Insurance operations generate steady, predictable cash.
And the whole model hangs on putting that steady underwriting together with smart, long-term investing. The fuel for that investing is the float, right? Can you break that down simply for us?
Sure. Think of float like this. It's basically money policyholders pay up front for coverage they might need later. The insurance company holds onto those premiums as reserves. But until claims actually need to be paid out, the company gets to invest that money, the float. If your underwriting is good, meaning you charge the right price for the risk, you make a profit on the insurance itself, plus you get this pool of money, the float, to invest effectively for free. Or even better than free if you have an underwriting profit.
And that float was massive for Fairfax. In 2009, it grew, nearly 7% to $11.6 billion. That is a serious amount of capital.
It is. And the letter does this really important calculation. It shows the total amount of money working for each shareholder. Super useful if you're analyzing an insurance company.
Okay, yeah. Let's walk through that slowly. It seems important, but a bit dense.
Right. So they take the float per share, those $579. Add the book value or shareholders' equity per share, $370. Then they subtract the net debt per share, which was $115, add it all up, and you get about $1,064 in investments per share. That's the total capital base working for the owners. They're investing not just their own money, but this huge pool of float, too.
Which really enabled those big contrarian bets we'll talk about.
Precisely.
But, okay, that giant capital pool is only useful if the main insurance business isn't losing money hand over fist. So, Section 2. Underwriting discipline. How did they make sure the float was an asset, not a liability?
They were incredibly strict. Even in 2009, a really tough soft market for insurance pricing, their overall consolidated combined ratio was 99.8%.
Okay, combined ratio, 99.8%. For listeners maybe not deep in insurance speak, what does that mean?
It means they made a small profit just from selling insurance. The combined ratio measures losses and expenses against the premiums they earned. Anything under 100% is an underwriting profit. Getting that 99.8% in a global recession, that shows serious discipline. They weren't chasing bad business just to grow.
Yeah, the letter explicitly says they don't care about market share, the top-line revenue. If it means losing money on underwriting, they'd rather shrink.
And they really did it. You see it with subsidiaries like Crum & Forster. Their combined ratio actually went up by 3 percentage points just because their earned premiums decreased. They were okay with that.
They preferred profitability over size?
Absolutely. They accept maybe a higher expense ratio temporarily or smaller revenues because underwriting discipline comes first. Conservative reserving, setting aside enough for future claims, that's the foundation.
So while they were super disciplined on the insurance pricing side, they were spending capital in another big way. buying back their own subsidiaries, privatizing them.
Yeah, Northbridge, Advent, Odyssey Air, they brought them fully back under the Fairfax umbrella.
And this was happening right in the depths of the crisis.
Exactly. Maximum fear, maximum opportunity. The Odyssey Air deal is the standout example. Fairfax took it public years before at $18 a share. In 2009, they bought the rest back at $65 a share.
Wow. $65. How did that compare to just holding the S&P 500 over that same time?
Well, for the public shareholders of Odyssey who sold back to Fairfax, they get a 17.3% annualized return over about 8 years. The S&P 500 over that same period, it returned negative 0.7% per year.
So a huge win for those shareholders, and Fairfax consolidated a valuable asset.
A total win-win. Shows their timing and ability to act decisively.
But buying these back cost a lot. The letter mentions they used 100% equity for the Odyssey purchase, issuing $1 billion in new stock. Why dilute existing shareholders right then? Seems counterintuitive in a crisis.
That's where you see their long-term thinking. Issuing equity, even if dilutive short-term, sent a powerful signal about financial strength. It was paramount. They wanted absolutely solid balance sheet ready for anything, and critically, they wanted to improve their credit ratings. They explicitly mentioned aiming for A-level debt ratings.
Okay, so sacrificing a bit of short-term pain for long-term stability and better borrowing costs down the road.
That's the trade-off they were willing to make. Safety first.
All right, let's pivot to the really exciting part. The investment strategy, the core of their contrarian success. And a lot of the cash for those buybacks came from that huge hedging win that the letter says was now over the credit default swaps.
Ah, yes, the CDS adventure. Probably one of the most famous and profitable contrarian trades of the whole financial crisis.
Explain CDS simply. What were they actually betting on?
Essentially, credit default swaps are like insurance policies, but on bonds or loans. Fairfax bought huge amounts of CDS protection, betting that certain corporate and financial debts would get into trouble or default. They were insuring against a collapse they saw coming.
And the payoff from being right on that bet.
Astronomical. Over the life of the trade, the total realized gain was $2.2 billion.
$2.2 billion.
Yep. They'd bought swaps covering a face value or notional amount of $15.6 billion. The cost to buy all that protection? Only $318 million. They eventually cashed out for $2.5 billion.
Unbelievable. That one trade basically generated a massive war chest.
Exactly. To give them all the cash, the dry powder they needed right when asset prices were hitting rock bottom. Everyone else had to sell, Fairfax could buy.
And the investment team certainly put that money to work. Their overall returns were impressive too, 16.4% in 2008 when markets crashed, and another 12.2% in 2009. So what did they buy with all that CDS cash?
They went for quality businesses they could own for a very long time. Think Wells Fargo, Johnson & Johnson, U.S. Bancorp, Kraft Foods. Solid blue-chip names bought cheap.
Interesting, they went into banks like Wells Fargo and U.S. Bancorp, given the banking sector was ground zero. How did they get comfortable with that?
They looked past the sector panic and focused on individual company quality. Specifically, they wanted banks with really risk-averse management cultures and strong, proven profitability. Wells Fargo, for example. They called it a wonderful bank. It actually used the crisis to get bigger, buying Wachovia, but crucially, it kept its high net interest margin around 4.3% and didn't take crazy risks.
And U.S. Bancorp sounds similar.
Very similar profile. Another well-run regional bank, also making smart little tuck-in acquisitions during the chaos. Plus, it had a really profitable payments business. Fairfax figured the market was punishing the good banks along with the bad ones, and they saw value there.
So this strategy, making these big, concentrated bets when opportunities arise, it naturally leads to uneven results, right? Volatile earnings. The letter actually calls this out.
Oh, they fully own it. They embrace the lumpiness, as they call it. The letter flat out tells shareholders, the unpredictable timing of these gains makes our quarterly or even annual earnings and book value quite volatile. No sugarcoating.
How do you manage expectations, though? With analysts, rating agencies, when your earnings per share can swing wildly quarter to quarter?
They just don't play that game.
Yes.
They explicitly say, no quarterly or yearly guidance from us. Their view is short-term swings are the price you pay for trying to get superior long-term results. They gave that perfect example from 2009 itself. Quarter one, they lost $3.55 per share. Quarter three, they made $30.88 per share.
Huge swing.
Right. And their philosophy is summed up in that famous line, we prefer a lumpy 15% to a smooth 12%. They optimize for the highest possible long-term return, not for predictable quarterly numbers.
Makes sense. And that long-term view wasn't just limited to North America. They were looking globally, too.
Definitely. Fairfax was already operating in over 100 countries by then. About a quarter of their insurance premiums came from outside North America. They specifically mentioned launching Fairfax Brazil, a new insurance operation in Brazil, and taking a 15% stake in All Trust Insurance in China, a leading private insurer there. They saw growth potential overseas.
The letter also seemed to signal a bit of a shift in what kinds of companies they wanted to acquire going forward, moving towards higher quality.
That's right. Less focus on maybe deep turnaround situations and more on pairing their investment skill with insurance companies that already had fantastic long-term underwriting records. They realized the power of combining their investment engine with a truly excellent, consistently profitable insurance operation. They were willing to pay a fair price for that quality.
And the planned purchase of Zenith National Insurance, which they mentioned, fits that mold perfectly.
Exactly. Zenith had this incredible 30-year track record, an average combined ratio of 95%, which is amazing, plus conservative reserving. That's the kind of high-quality operation they were now targeting. Marry great underwriting with great investing.
So let's wrap up with the philosophy behind all this. The letter sprinkles in some historical wisdom and guiding principles.
Yeah, some really timeless stuff. They mentioned how the British East India Company's success was partly down to frenetic inactivity. Basically, wait patiently, do nothing for long periods, but when the perfect opportunity comes, act decisively and with scale.
Sounds like their CDS trade and post-crisis buying.
Precisely. And then there's the warning, the cautionary tale.
Ah, the AIG example.
Exactly.
It's sobering.
It really is. They pointed out AIG took 89 years to build up $100 billion in shareholder capital, and then it lost almost all of it in just 1 year, 2008. It's a stark reminder of how quickly things can go wrong if you're not careful. It reinforces the CEO's personal motto, which he shares it was actually his high school motto, be vigilant.
Vigilance, patience. It all feeds into their quite cautious outlook on the economy back then, too. They talked about the possibility of maybe a long period of flat growth in the U.S., like the 1930s, or Japan in the 90s.
Right, but they saw that challenging environment not as a negative, but actually as the ideal hunting ground for disciplined value investors like them.
Okay, so if we boil it down for you, the listener, the big lesson from Fairfax in that crisis seems to be this. You need that rock-solid discipline in your core business, like refusing to write insurance at a loss, even if it means shrinking rake. And you combine that with bold, independent, contrarian investing, fueled by patient capital that can wait for the fat pitch. That's how they generated exceptional results.
Yeah, and it all rests on a specific culture. They talk a lot about being fair and friendly, about teamwork, and always keeping that long-term goal, the 15% book value growth in sight, even knowing the path there will be, well, lumpy.
Definitely not smooth.
Definitely not. So here's a final thought for you to consider, straight from that 2009 letter. Fairfax pointed out something fascinating about General Electric. GE actually made money through the crisis in both 2008 and 2009. Yet back in 1997, the market valued GE at 27.5 times its earnings.
Okay.
But in 2009, after proving its resilience, the market valued GE at just 8.7 times its normalized earnings.
Wow, that's a massive difference in valuation for a company that was still profitable.
Exactly. It was roughly 70% cheaper, despite performing well.
Yeah.
So the question for you is, what does that huge disconnect tell you about market psychology in a crisis? And how does Fairfax's clear observation that the stock market is often not efficient reinforce the need for you to think independently when making your own investment